traders, welcome back to the channel. So today we're going to be discussing a crucial part of trading, and that is your exits. And specifically, we're going to be talking about where to exit if you're wrong. In other words, where to set your stop losses. Before we get started, I just want to make you aware that Forex trading is risky and most traders lose money. This video is for educational purposes only. All charts displayed are historical and nothing discussed here should be taken as trading advice. We provide trading strategy ideas that you need to backtest and try out for yourself. Alright, now when it comes to setting stop losses, you don't want to set your stops too tight because obviously it means that you're going to be getting stopped out a lot. But also you don't want to set your stop losses too wide because of course you'll be risking more money and you might mess up your risk to reward ratio. So there's one technique that I swear by, and it's based on a simple yet very powerful concept. You should place your stop at the level which invalidates your trading setup. I know this might sound complicated, so I'm going to break it down for you. Okay, so let me explain with a simple example. Imagine you're trading in a trending market. So let's say it's an uptrend. And at what point would you say that this trend is no longer valid? Would it be at point A, i.e. at a minor pullback, at point B, at a more significant retracement, or at point C, a deep retracement that breaks the pattern of higher highs and higher lows? If you chose point C, of course you're correct, because if the price had to go back to point C, the uptrend is clearly broken and the trend is no longer valid. So this is where your stop loss should be. So if we look at another example, and this time I'm going to be looking at trading in a range. So here you see the market is moving up and down between two support and resistance levels. And generally, you'd place your stop below the support, point C. So if the price breaks below this point, the support level is broken and the range is invalidated. Now, this seems simple enough, but it can be quite subjective. So you want a more quantitative way to actually set your stop loss up. And this is where the average true range comes in. Now, as we know, the average true range is a volatility indicator, and it indicates how much volatility there is in the market over a certain period of time. So for example, as you can see here, the ATR is set to 14, and this is the 4-hour chart. So it measures the average true range of the last 14 4-hour periods and averages it out. And as you can see here too, when the market is highly volatile, the ATR value is high. So for example, this spike showed an average true range of around 34.7 pips, whereas here, when the volatility was low, the ATR value was low too. Now, why this is important is that it actually averages out the daily movements in the market, and it gives you a value for those daily movements. And the idea is that you want to set your stop loss one ATR beyond the area of value. Let me explain how this works with the chart example. So imagine that we're looking at the chart of the Euro USD on the 4-hour time frame. The price comes into an area of value or a long-term level of market structure that is very well respected. It is also nearing the 20-period EMA, so I'll likely set up a buy limit order at the 1.11480 level, as you can see here. This means that a long position order will be executed when the price hits the 1.11480 level. So where would you set the stop loss? Well, as we said earlier, the trade would be invalidated if it went below this level here. In other words, where the uptrend would no longer be an uptrend. So our level of value, or the place at which the uptrend would be invalidated, would be 1.11081. So you would then place the stop loss 1 ATR below the area of value, or the area where your trade would be invalidated. Again, this is 1.11081. And at this point, the ATR is 0.00233. You would therefore subtract the ATR from that level, which would be 1.11081 minus 0.00233, which equals 1.10848. And it's pretty simple. It means that you've now set your stop loss far away from the noise, that it gives you some breathing room, but it's not too far away that you're going to be risking too much money. Let's look at another example. Suppose you're shorting after a bearish price rejection. Where should your stop loss be? Again, you might identify this as an area of market structure with the confluence of the 50 EMA. If I entered right here, I would set my stop at 1 ATR beyond the resistance area. So again, this would be 145.936, and your ATR is at 0.717, and I add these two together and my stop loss is at 146.652. And again, this would protect you, but it would also give you some breathing rooms. So the stop is not too tight, but it's also not too wide. A quick pro tip here, a lot of traders ask me why not 2 or 3 ATRs away from that area of value. And I find 1 ATR is the sweet spot. You are already taking into consideration the area at which your trade would be invalidated. And I find 2 to 3 ATRs beyond that is just a little bit too wide. And a tighter stop loss for me doesn't work either, because even though you might be able to open a larger position size, you often get stopped out prematurely. So I find that the 1 ATR balances your trade. It gives you enough room to breathe while keeping your risk in check and ensuring that your stops do the job of helping you minimize your losses. So that's it for stops. I hope you found this video helpful. In the next couple of weeks, we're going to be releasing a video on how to set your take profits and how to refine your risk to reward ratio. Thank you so much for watching. Please remember to like and subscribe and send us any questions through to fxscouts.com.